Suppose you own a small business that you want to expand, but you're strapped for cash. Yet, you don't want to sell ownership stakes or shares, or you've already sold all the shares you're comfortable selling. Well, you could borrow the needed funds from willing lenders with a commitment or bond to repay with interest. That means you issue them bonds or debt. Those lenders now own your business's debt and become its bondholders. Let's explore how all that works and peek into the world of the fixed income or bond asset class. Businesses and governments can obtain outside funds by borrowing. They do so by issuing bonds or selling debt to interested lenders. These bonds have a fixed or variable interest, a set payment frequency, and an agreed repayment period. A bond's interest payment is also called a coupon, and its repayment period is also called its duration. Bonds reach maturity at the end of their duration. At that time, the borrower or bond issuer must return the amount they borrowed, or the principal, back to the lenders or bondholders. For some bonds, the issuer has the right to pay off or call the debt early and stop making coupon payments to bondholders. These are known as callable or redeemable bonds. Moreover, a single lender is rarely able to meet a borrower's need. That's why bonds are usually issued in units, so each lender can buy as many units as they can afford. And the bond's coupon and duration apply equally to each unit sold to the bondholders. The price of a bond and the coupon it will pay to bondholders depends on the prevailing and anticipated inflation and interest rates, as well as the bond issuer's likelihood of default. Default being the situation where the bond issuer is not able to pay the coupons in line with the payment interval or repay the principal at the bond's maturity. The positive correlation between inflation and interest rates is well established, since raising interest rates is the main tool central banks use to control rising or high inflation. This chart from Luisa Vieira illustrates the relationship between the two. High or rising inflation and interest rates during a bond's duration means the bondholder's principal and coupons will be worth less when they receive them in the future. So the yield or interest rate on bonds being issued in such periods needs to be high enough to compensate bondholders for the inflation and interest rate risk. In such times, bond issuers are limited in the asking price they can set for their bonds, as they need to make the bonds more attractive given the possibility that interest rates will rise during the bond's duration. Lenders can simply wait for bonds issued in the future at those higher interest rates instead of buying now, and this lack of demand would further drive down bond prices today. Bondholders can also resell their bonds to other lenders before maturity. Relative to the bond's original issue price, face value, or par, the resale can occur at a lower price or at a discount to par, and the seller records the capital loss. Or the resale could occur at a price equal to par and the seller recoups their full principal they invested in the bond. Or the resale could occur at a higher price or at a premium to par and the seller records the capital gain. Like the original issue price, the resale price is inversely related to the available interest rates on similar bonds at the time of the resale, and that's tied to current and expected inflation. So in a rising or high inflation and interest rate environment, borrowers or bond sellers sell their bonds at lower prices while offering higher interest or coupons. The opposite is true in a low or falling inflation and interest rate environment. As a rule of thumb, for each percentage rise or fall in interest rate, a bond's price falls or rises by the value of its duration expressed as a percentage. So a 10-year duration bond's price will fall or rise by 10% for each 1% rise or fall in interest rates. This explains why when inflation and interest rates fall, bond issuers pay off redeemable or callable bonds before their maturity. The bondholders only get the bond's value at the preset call price, which is usually the face value, so they get their principal back, but they lose the interest payments for the remaining duration. Meanwhile, the bond issuers can reissue the called bonds at a higher price and lower coupon rates. A borrower's credit risk is summed up in its creditworthiness, which is like the credit score people get based on things like their income and loan repayment history. Moody's, Standard & Poor's, and Fitch are the three main global credit ratings agencies that evaluate and publish credit ratings of governments and corporations. For example, Standard & Poor's or S&P rates borrowers on a scale of AAA for strong, AA for satisfactory, A for adequate, B for uncertain, C for likely default, and D for already in default. However, these ratings agencies are not faultless, and as John Maxfield wrote for The Motley Fool, ratings agencies are always the last to know when there's trouble lurking in the borrower's books. For instance, Standard & Poor's had an A credit rating for bonds issued by Lehman Brothers, then the fourth largest U.S. investment bank, when the bank went bankrupt in the 2008 subprime mortgage crisis. Nevertheless, a borrower's credit rating is important, and the better it is, the lower the bond issue price and coupon it has to offer to attract lenders. So, borrower's default is not the only way bondholders can lose money on bonds. That also happens if borrowers pay their debt early or call their bonds, or if bondholders resell their bonds at a price below par due to prevailing inflation and interest rates rather than holding them to maturity. Taking call risk, inflation risk, and interest rate risk together with borrower's default or credit risk, it's clear that although fixed income assets are significantly less risky compared to equities, they are not risk-free. Now let's see the different ways the fixed income or bond asset class is further diced and spliced. There are 5 ways bonds can be classified: by borrower or issuer type, bond duration, borrower's creditworthiness, the bond coupon type, or the borrower's location. Bond issuers could be national or sovereign governments, government-backed agencies, municipal or local governments, and corporations or businesses in the private sector. Bond durations can be ultra-short, short, intermediate, long, or ultra-long-term, depending on the number of years to maturity. Depending on the bond issuer's credit rating, its bonds are classified as investment grade, non-investment grade, high yield or junk, and non-rated bonds. Based on the type of coupon a bond pays, it can be a fixed rate, floating rate, or zero coupon bond. Lastly, depending on where a bond issuer is located, its bonds can be developed or emerging market bonds, or local or foreign bonds. Now let's take a closer look at each of these bond classes. Government bonds are issued by central banks like the US Treasury and the Bank of Canada as bills with duration less than or equal to a year, or notes having 1 to 10 years duration, or bonds with duration greater than 10 years. These bonds are backed by the full faith and credit of the issuing governments, and their coupons are serviced by the issuer's taxation powers, making them the most creditworthy or low-risk but lowest yielding bonds. Some notes and bonds, like Canadian Real Return Bonds and US Treasury Inflation Protected Securities or TIPS, offer inflation protection by altering their principal and coupon rates with changes in the Consumer Price Index and providing a real rate of return. A cool feature of government bonds is that their interest payments are subject to federal income tax but exempt from state and local taxes. Some governments also issue small denomination saving bonds to individual investors. These pay no coupons but are issued at a discount to their face value and are not subject to state, provincial, or local taxes. The difference between their discounted price and face value is realized by the bondholders at maturity and acts as a fixed interest over the bond's duration. While the US Treasury still issues saving bonds like the Series EE or Series I bonds, the Bank of Canada has stopped doing so, and only the province of Quebec still does in Canada. Agency bonds are issued by government-affiliated entities and are either direct obligations of the government or fully guaranteed by the government. Their government backing makes them very creditworthy or low risk, but also lower yielding. That said, they offer higher coupons than government bonds while being slightly riskier. Examples of agency bonds in Canada are mortgage bonds issued by the Canada Mortgage and Housing Corporation, CMHC. In the US, we have the Federal National Mortgage Association, or Fannie Mae, and the Federal Home Loan Mortgage Corporation, or Freddie Mac. Municipal bonds or munis are issued by local governments to bankroll daily spending on capital projects like building roads, parks, and schools. They can be general obligation, revenue, or conduit municipal bonds based on how their principal and coupons are backed. General obligation bonds are backed by the taxes the municipality collects from residents. Revenue bonds are backed by the revenue the municipality generates from the capital project they borrowed against, for example, highway tolls. Lastly, conduit bonds are backed by the third party on whose behalf the municipality issued the bond, for example, non-profit colleges or hospitals. Municipal bond coupons are usually exempt from federal income tax, and if the bondholder lives in the municipality, they are always exempt from state and local taxes too. With these tax advantages in mind, municipal bond issuers usually offer lower interest or coupon rates compared to other types of taxable bonds with similar duration and creditworthiness. Corporate bonds are issued by corporations and businesses to raise funds instead of borrowing from banks at higher interest rates or issuing new shares and diluting existing shareholders. Companies are usually less creditworthy than governments, government agencies, and municipalities, so corporate bonds offer higher interest rates to compensate for the higher risk. An example of a corporate bond was Apple Inc.'s May 2014 bond issuance. Aside from company debt like Apple's, Canadian banks, trust companies, and brokerages issue guaranteed investment certificates or GICs to their depositors. Certificates of deposits or CDs are the US version of GICs issued by banks, credit unions, or brokerages to depositors in the United States. GICs and CDs are issued with fixed or variable interest rates, and their principals or deposits are usually insured by the Canada Deposit Insurance Corporation (CDIC) or in the United States by the Federal Deposit Insurance Corporation (FDIC). GICs and CDs are term deposits with 3 months to 5 years duration, and they come in 3 main types: cashable, redeemable, and non-redeemable. Cashable ones allow no penalty anytime early withdrawals. The redeemable ones penalize early withdrawals, and withdrawals are only possible after a holding period. Meanwhile, the non-redeemable ones do not allow early withdrawals and must be held to maturity. GICs and CDs are not exactly corporate debt, and their issuers are not the government or government-linked, but they do offer you guaranteed interest and principal for the opportunity to turn a profit using your deposits. In October 2023, the highest yielding CDIC insured 1-year duration GICs in Canada were from Oaken Financial, Wealth One Bank of Canada, and People's Bank. Meanwhile, in the US, the top 3 yielding FDIC insured 1-year duration CDs were from Popular Direct, Merrick Bank, and the Lending Club. Classifying bonds by duration results in ultra-short, short, intermediate, long, and ultra-long-term bonds. Ultra-short-term bonds have a duration less than a year, and a good example ETF for this is iShares Ultrashort-term Bond ETF. Short-term bonds have a duration from 1 to 3 years, and a good example for this is Vanguard's Short-term Bond Index Fund. Intermediate bonds have a duration from 4 to 10 years, and a good example ETF for this is Vanguard's Intermediate Term Bond Index Fund. Long-term bonds have a duration from 11 to 20 years, and a good example ETF for this is Vanguard's Long-term Bond Fund. Finally, ultra-long-term bonds have a duration exceeding 20 years, and a good example ETF for this is Vanguard's Extended Duration Treasury Index Fund. These bonds could be issued by any of the bond issuers discussed earlier, and they usually pay higher interest with increasing duration or exposure to risk. We've talked about the relationship between bond duration and changes in inflation and interest rates. Let's see how that looks for bonds of different duration using government-issued bond ETFs as a proxy. Comparing the bond price and yields of bond ETFs with varying durations over the last decade, we see that rising interest rates is accompanied by falling bond prices and rising bond yields. Also, shorter duration bonds are best suited to high or rising interest rate environments as their price falls the least while their yield rises quickly. We also see that falling interest rates is accompanied by rising bond prices and falling bond yields. Also, longer duration bonds are best suited to low or falling interest rate environments as their price rises the most while their yield falls slowly. Investment-grade bonds are those issued by borrowers the bond market believes have a lower likelihood of default and, as a result, higher credit ratings. Bonds rated Baa or above by Moody's and BBB or above by S&P and Fitch are investment-grade bonds. Since investment-grade bonds have lower default risk, they also offer lower coupon rates or yields. Government agency, general obligation, municipal, and some corporate bonds fall into this category. Non-investment grade bonds are those issued by borrowers the bond market believes have a higher likelihood of default and, as a result, lower credit ratings. Bonds rated lower than Baa by Moody's or BBB by S&P and Fitch are non-investment grade bonds. Since non-investment grade bonds have a higher default risk, they also offer higher coupon rates or yields and are commonly called high-yield, speculative, or junk bonds. Most bonds issued in emerging markets fall into this category. In developed markets, some corporate bonds fall into this category, usually those issued by startups, capital-intensive firms with high debt-to-equity ratios, and fallen angels, which are bond issuers that previously had high credit ratings. Non-rated bonds are those issued by borrowers whose creditworthiness has not been rated by a reputable credit ratings agency. Examples would be revenue and conduit municipal bonds from states, provinces, cities, and local governments. Fixed-rate bonds pay the same interest or coupon throughout their duration. The decreased interest rate risk usually comes with a lower coupon rate. Examples of fixed-rate bonds are U.S. Certificates of Deposit or CDs and Canadian Guaranteed Investment Certificates or GICs. Floating-rate bonds pay interest or coupons that vary with market interest rates. Interest rate risk is prominent here, so these bonds make sense when lenders expect market interest rates to rise. Examples of floating-rate bonds are Canadian Real Return Bonds or RRBs or Treasury Inflation Protected Securities or TIPS in the U.S. These bonds have coupon rates that adjust to the Consumer Price Index or CPI every 6 months. Zero-coupon bonds do not pay coupons. Instead, they offer a discounted purchase price relative to the bond's face value, and the bondholder gets the face value at maturity. The difference between the discounted price and the face value is the bondholder's total return, which mimics the fixed rate of return over the bond's duration. Notably, holders of zero-coupon bonds with multi-year durations must pay taxes on a yearly basis, even though they do not actually receive any income until the bond matures. Examples of zero-coupon bonds are US or Canadian Treasury bills. Bonds are issued by governments, businesses, or corporations in countries around the world. As this chart from Visual Capitalist shows, 45% of the global bond market is in the US, 29% is in China, and 20% is in the EU. If your bonds were issued in a location outside your country of residence, then you've acquired foreign bonds. Otherwise, you own local bonds. Developed market bond issuers are generally more creditworthy than their emerging market counterparts. However, one reason to be interested in government bonds issued outside of the developed markets is the relatively lower debt-to-GDP ratio of the issuing governments. Here are 2 more reasons to explore emerging market bonds. To start with, looking backward, their real rate of return accounting for inflation has been higher than those in developed markets. In addition, looking forward, their interest rates are forecast to remain high or rise further. Finally, currency risk is a huge factor to consider when looking at emerging market government bonds or any other emerging market bonds. But there are currency hedges available to blunt that risk. Right, that does it for fixed income. Next, we'll delve into the cash and cash equivalents asset class.